Good morning, good afternoon, good evening. Welcome to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. Today, we are talking about what to do with your 401k when you leave the company or you retire for good. There's a lot of different options. If you've not been here before, our podcast is split into 4 sections. We talk about us professionally, personally, we dive into content, and then we also answer questions. If you are returning, if you've seen another episode, please, if you're watching on YouTube, can you just sub to the channel? That's all I want. I don't want to like, I don't want to comment, just sub, because that's really helping us out. If you're listening to the podcast, if you are not a follower, which strangely enough is only 1 out of 4 listeners, but if you're that 1 out of 4, please go ahead and follow the show. If it's your first time, sit back, you don't have to do anything, just enjoy the content. Jordan does our disclaimers. He's going to do it right now.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
I know for a lot of people that was a mix-up. He's been doing it at the end, but he did it now so we can get it out of the way. Heather, we're going to start talking about you first. How are you?
I'm doing great. In the firm quick update, I'm taking on a new client at the end of this month, which I have not taken on a new client in, I'd probably say 4 months now, which is a long time. But after summer vacay, I'm rejuvenated and ready to go, and I'm excited. So that's my update. Yeah.
It's always nice when fresh blood comes in. Mm-hmm. It's like, oh, new situation. Let's get going. Well, over here, I am already gearing up for next tax season in terms of January 2026. This will be the first year that I am doing tax filing without outsourcing it. So I'm doing it myself through tax software, e-filing, and all of that. So I've got the software. I'm using ProConnect if anyone is interested through Intuit. So then I have my weekly call with my assistant. And I'm like, all right, Christian, I need you to learn this software. And you can't ask me any questions about it because I haven't used it yet. And the look on his face was like, oh, okay. And I'm like, all right, I'm literally paying you to train. So I need you to do all the webinars. I need you to go through and like figure out what happens with tax returns. And then I reset. I'm like, how much have you done with tax returns? He's like, I'll learn. I'm like, that's all I need to hear. Like, I will teach you as much as you want to. But it's just a case of, okay, learning the software, getting very familiar with it so we can actually do some tax performers going through into full reviews and project people's situations. All right. Moving on to our content, let's dive in. So we're talking about 401ks and what to do. There's obviously different things that you should be doing if you retire versus leaving a company, and there's different rules. So we're going to jump into all of that so you know what to do. Miss Heather, you know you like to start things off. So
I do, huh?
The floor is yours.
All right. If you're retiring, if you're before 59 and a half, then you most likely will want to keep your 401k at your employer so you can take advantage of the rule of 55, meaning you're not paying penalties. You can take distributions as a normal retiree.
Yeah, you got to explain the rule of 55.
You do it.
All right, rule of 55. If you retire and you're 55 and older, you can keep your 401k with your employer and you can withdraw from it without the 10% penalty. You just pay taxes on your withdrawal. If you move that 401k to an IRA, that age 55 goes to 59 and a half before that penalty is eliminated.
If you keep your 401k at your former employer and you are retired, and I have had clients in this situation, there are some, I want to say some negatives. I'm normally a positive person, but there are some negatives I don't like. One, you have to they automatically withhold 20% from a distribution. Automatically. I cannot edit it. That drives me crazy because in my client situations, because, we do all the things for tax efficiency, I didn't need 20% withheld. So we were having to take more out. The other thing I didn't like is with my retirees, and I know Dave does the same, is depending on what's going on in the market, I am picking and choosing where I am pulling my clients' distributions from, what investment, right? So if the market's really down, I might want to be pulling from cash or bonds. If the market's really up, I'm pulling from the investments that are over their target allocation. Okay. Well, with the 401k, at least in my experience, the client says, hey, for example, I'm going to pull $20,000 out, and it's the exact percentage that is set up in the 401k allocation. You can't cherry pick it. So I have to go in every few months, and my client and I have to rebalance to how we wanted it. It's just a lot more work. But and there are more fees, I would say, probably with a 401k. But if you're doing the rule of 55, you just work around it. I've done it. It's fine. That's my pretty little bow, I would say.
I'm going to untangle that bow and tie it up myself. One thing being, if you're retiring at 55, if I'm having someone retire at 55, they've already got a designed income plan. Most likely that retirement income plan is not dependent on taking withdrawals from the 401k for the entirety of that income. It's going to be for something else. So they're going to have cash lined up for a few years. So if they're 56, they leave, they may get to 59 and a half just using cash from their portfolio before we need to touch the 401k. And at that point, we roll it to an IRA. It's just there should you need it.
My client situation in that one where rule of 55 came in is stock market did better than we projected. They retired way earlier than we projected, right? So I didn't even have that option. Most of their retirement assets, unfortunately, are in 401k.
All right. What happens if you're not 55? Let's say it's a normal retirement.
Mm-hmm. I mean, most of the time, roll it into an IRA. So you have the control. I have my clients pay estimated tax payments. I like to control that, not the automatic withholding. And then also I can handle the distributions for them, which they really like, right? If it's at a 401k, I can't place the trades and send them the distributions as much.
There's a big thing when you roll over your 401k, and it's how you have your 401k provider title the check. And this, I emphasize in like capital letters in an email, back it up with a phone call. Do not have that check made out to you personally, and that's it.
Rollovers
you have to have.
Actually, okay.
Let me get through the example.
Yes, sir, Dave.
So if you're rolling over your IRA, your 401k to an IRA, have that IRA account set up, have the account number ready. Then you go to your 401k provider and say, I need you to write a check to Charles Schwab for the benefit of me. Here's the account number. If they then say, we have to send it to the address on record, and that's your house, yuck. It's fine, but I don't like it that way because now you're getting involved and there's extra rules. Make sure that they can send it directly to Charles Schwab to do that rollover. If they have to send it to you, you have 60 days to move it to that IRA. Typically, that's fine. You just mail it off to Charles Schwab. Do not have that check given straight to you because there's a 20% tax withholding. And then should you then send that check to the IRA, you then have to come up with that 20% funds to then make that contribution whole, that rollover whole, or it's classified as a distribution. And if you're under the age of 59 and a half, you're going to get a 10% penalty on that. It is a mess.
I can't tell you how many clients have me help with the rollover process. I will say for people that can't afford a Dave and Heather, I feel bad. Like it's not easy. And the financial planning firms throw out all this language that is very confusing and make you think it's going to be taxable. And why, with all the technology we have today, including AI, we can't just wire funds directly. Like why can we not do this electronically? Why are we still doing it via checks? I mean, that is mind blowing to me, but that's another.
The part I find confusing is if you're a 401k plan, if you have an ex-employee call you up and say, I would like to roll over my $1.5 million 401k, who in their right mind would think that that person wants to take that as a check into their checking account?
If you are retiring and rolling your 401k over, number one, get a statement and look at the contribution types. Pre-tax, Roth, and after-tax. Those are the three main ones. Pre-tax is going to go into a traditional IRA. Roth is going to go into a Roth IRA. That's simple. After-tax. After-tax, you want it to go into a Roth. That is very important. And I will tell you, this is going back 7.5 years ago. One of my very first clients had after tax, sizable after tax in their 401k. And little Heather, that is like learning about getting her company. And I'm like, oh dear gosh, I have to figure this out. But I added so much value. The client had no idea, and we got it into the Roth. It wasn't really that difficult.
So I would say the tweak there is understanding the after-tax contributions and the after-tax growth.
The earnings, yes.
Yeah, because they have to be split up too. Contributions can go to the Roth. The growth has to go to the traditional. And some statements will be very detailed and split that out. And others will be like, this is your balance.
Yeah.
And they won't help.
All right. What if you, Dave, are still working? You're going from one company to the next. What are you doing?
Two options. One, you can take your old 401k and move it into your new 401k. I would say I'm split 50-50 on this. And mainly it's because what does that new 401k look like?
What are the
Who is the provider to start with? Is it an insurance company or an investment company? Clues in the name. What are the investment types in there? Like, what are the companies that are being offered? And then look at the fees, because you can have great investments, but the fees of that company could be really high. And so it kind of negates each other. If all of that plays out, take your old 401k and roll it to your new 401k, and then just rinse and repeat. You can just add your new contributions into that new 401k. If it's not a great 401k that you're moving to, that's when you can say, okay, let's take my old 401k and let's roll it to an IRA. I can choose the investments. I can choose where it goes. I have full control.
I will also say that if you are a high income earner and you have been doing the backdoor Roth, just be careful if you are going to roll your 401k into a traditional IRA because you just made your backdoor Roth taxable. Go back to one of our podcast episodes where we talk about it, but you now have balances in traditional IRAs, so doing a backdoor Roth will become taxable. Many of my clients that are in asset accumulation, I have their 401ks all in one 401k. We combine them. Yeah. So we can continue doing the backdoor Roth. I will tell you, one client, we actually kept a sizable 401k at their former company because their new 401k was not good options, let's just say.
Yeah, it's definitely on a client-by-client basis, just analyzing this whole thing. And I just had a client start a new job. He had a 1-year waiting period before he could start using the 401k.
Wow.
I'm like, well, scratch that. Let's just move your old 401k to an IRA because I don't want you stuck in this old plan while waiting for this new one to become open to you. Because the old plan isn't great anyway. So we're just going to move it.
Yeah.
If people have questions on this, feel free to reach out because everyone's got their own unique situation, but you really don't have that many options. You just have to make sure you do it right. And
listeners should know by now, Heather loves questions. So please email them in. Dave, what's that email again? Hello at.
I say it every week. Come on.
POTW.com.
You're fined $4,000 for getting the URL wrong of your own podcast. It's hello@playbookotw.com.
So spell out playbook, then otw.com. All right, now we've had a whole set. Now people are going to go do it. I hope they're on their iPhone right now asking their questions. All right.
Before we get into a fight, let's go into our segment called What Would You Do?
I am 55 and just left my job. I am starting a new position that is 50% base pay and 50% commission, and I plan to work here for the next 10 years. Should I move this old 401k to an IRA, leave it alone, or transfer it to my new 401k plan? Dave, what do they do?
There's actually a lot of things going on here. So you're 55, which means that you could leave your 401k there and you could take distributions out of it. But your new job is 50% base pay and 50% commission. So you're not going to zero with this new position. If you were 100% commission, I would say leave your 401k there because there is a chance you might need it for some income. If you're fine with your income, with that base pay and commission, and you plan to work there for the next 10 years, the 401k is a good plan. I don't think it's a bad move to roll that 401k into that new 401k. Just keep things simple. You can't, if you roll it to an IRA, you can't really take it out without a penalty anyway. So you're working, you're fine. If it's not a good 401k plan that your new company's in, then I'm rolling it to an IRA. Done. Dave's bow.
Dave's bow. Oh, Dave has a bow. Okay.
It's a manly bow.
It's a manly bow. What color is it?
Camo. What's the manliest color? Black. I don't know. Question number 2. I have 4 old 401ks with previous employers, and I like the fund holdings in one of them. Can I move my old 401ks to this previous employer's plan to use those holdings? If I can't, what would you suggest?
So what I heard here is previous employer. That was key. I have not seen a previous employer allow roll-ins. If you leave the job, they normally don't let you roll it back in. I think there are some exceptions in their plan document, but most employers don't do that. So it's most likely not going to be able to be an option for you. Having 4 401ks, though, that's too much to manage with asset allocation. You could easily lose one or forget one. I don't think that's a good idea. I would definitely combine them. If your new 401k is great and has great investment options and does not have an insurance in the name, then I would roll all of them in. If not, then IRA, but just note, backdoor Roth just closed. Boom.
Bow.
Emerald green bow.
Your question.
Well, I'm sorry, someone said break. I have a 401k that has contributions split between pre-tax, after-tax, and Roth. All 3. Is there anything specific I should be doing with this? Or can I roll it all into one IRA? Oh boy. Oh boy.
I actually just had a client who did this, and it was a faux pas on my part because I didn't review their 401k statement beforehand. So they called their 401k provider up and they said, okay, here's my account number. Let's move my 401k over.
The plan didn't stop it. The plan didn't say anything.
No, so I got an email summary from the client saying, here's what's going over. And they're going to send all these different contribution things over to this one account. I'm like screaming in my email response, go, no. And part of me was screaming at myself. So I'm like, all right, I need you to call them back. Tell them to stop. Let's set up a Roth IRA for you. And then we can start again. So then it is pre-tax, traditional IRA. After-tax contributions, Roth IRA. Roth 401k goes to Roth IRA. Do not roll it to one.
No.
The reason being is your Roth is all post-tax. You roll that to a traditional IRA that's pre-tax, you just messed up your whole tax situation there.
You just made it all, you just made all that money have to pay ordinary income tax when you take it out, when you could have just paid 0 tax. I would choose 0 tax any day. Don't mess this up.
Let's go into our next section called highlights. All right, this is where you get to know about us. Personally, I have to go first because I did this today and heck was I excited. So 2 days ago, Sarah can't get out the garage. The motor goes, the garage door doesn't work. The gears have pretty much stripped themselves. So we have to get a whole new unit. So the garage guy comes out and he's like, I'll just set you guys up with a new unit. I'm like, give me the basic as a garage door. I don't care. So he builds the whole thing and it comes with this, was it MyQ, I think it's called? A lot of the technology in my house is still pretty old. So now my garage door opener has a Wi-Fi in it. I can connect it to the Tesla, which has geofencing on it. So I can drive up to my house and as it gets 100 feet or closer to the house, the garage door opens. As I leave my house, 50 feet away, it closes the garage door.
That's amazing.
So I was pretty stoked to do that. It's like, oh, I don't need a button anymore. And now all my kids can have the app on their phone and they can open the garage door from their phone and we don't need a keypad anymore.
That's really nice. That is very nice. That is
so,
okay.
I was kind of psyched.
Now I'm kind of a little excited for my garage door to eventually die. Now I know something.
Yeah, you're just going to walk through with a hammer and just like throw it up in the air and just, Alex, it broke.
But actually, with my story, I want nothing in my house to break right now with my highlight, let me say. So don't put that out in the universe right now. So at first, for our master bathroom. So we've left for 6 weeks. I took pictures of the house before we left. All right, we're now back. here are some updates that have gone on.
Mm-hmm.
One of my updates that I had already shared previously is we were going to do just the vanity. And then I was like, well, I can't redo the vanity to Heather-esque and then have this older shower. So we decided to rip out the shower and redo the entire master bathroom now. My husband was not happy about that decision.
Okay.
So I get a picture text while we're gone. There was black mold behind our tile in our master bathroom shower from a window that was leaking, and we would have never known. And we sleep, like the master bathroom is attached to our bedroom.
Mm-hmm.
So my contractor was like, thank gosh you decided to redo the shower. And we have to redo the window. We closed the window completely, had to redo all the framing. Okay, fine. So I feel very good about that decision. So now paying for the redo of the entire master bathroom, my husband is more on board. So check, win. So my kitchen is probably going to be a little ridiculous. And we were told, we bought 5 slabs of marble for our kitchen and fireplace area. And my contractor said, we might need 6 if the veins of the marble don't line up. Fine. Okay. So I, of course, budgeted for 1 more. No, they need 8.
I'm assuming if they're doing slab work, you have cabinets in.
No. I have the cabinet boxes, not the cabinet faces. And the appliances. Floors are done. Baseboards are done. Bathroom is demoed. Framing is put in. New fireplace is put in.
Okay.
We cannot live there right now. Let me put it that way. If I showed you a picture, we cannot live there.
Oh, you make me nervous for when I do my kitchen next year. Mm-mm.
Well, you can learn from me. And hopefully you get to see it when you're in town.
I hope so too.
Yeah, I really hope for everyone's sanity that it's done, or I'm not going to be happy.
Thank you for listening to this episode of Playbook of the Wealthy. You can find us wherever you listen to podcasts. And if you want to watch the video version of the show, which is doing really well on YouTube, by the way, thank you. You can watch it on YouTube. You can watch it on LinkedIn. You can watch it on Instagram. If you want to send us a question, you can email us at hello@playbookotw.com, and we'll see you next time.
I love questions. Please email them. I said that earlier. And toodles.